All right. So we're going to go through aggregate supply and demand, but the focus will be on inflationary and recessionary gaps. First, though, do a real quick review. So you remember aggregate supply and demand shifters. So our aggregate demand shifters, consumer spending, government investment, and exports. Shifters of aggregate supply. Little different acronym here, but we have aggregate supply, we have change in resource prices, change in technology, change in actions of government, and change in productivity, which would happen after investment. So the actions of government include your taxes, your subsidies, and your regulations. Resource prices, there's your oil, there's your wages, and productivity. So your factories are getting better, your workers are working faster, and that's usually happening after the change in aggregate demand, which would have happened because of investment spending. So TARP. All right, so there's a quick practice. So pause the video here and write down 1 through 10. And this is a quick little quiz. It really is a good idea to do this just to kind of get a gauge in your own mind about where you are with identifying aggregate supply and demand shifters. So pause the video and write down 1 through 10, then answer these questions. All right, let's go through the answers. And the first one, decrease in consumer spending, is B, decrease in aggregate demand. That one's pretty clear. Number two is A. So sometimes people get tripped up with this one, but remember, we want our neighbors, we want our trading partners to do well, because then they'll buy more stuff made in America. Again, remember, that also includes services. Doesn't just have to be goods. Next, increase in the price of imported oil. Well, that's going to be D. It's going to shift aggregate supply to the left. Number 4, large increase in government spending on infrastructure, of course, is A, increase in aggregate demand. Wages. So, like number 3, wages will be D, decrease in aggregate supply. Number 6. So if business thinks we're heading into recession, they're going to pull back their spending. Investment spending is most volatile, so that would drop and we'd have a decrease in aggregate demand. Number 7, so we're getting more and more into interest rates. So if interest rates are low, people are going to buy more stuff. They're going to buy interest rate sensitive cars, houses, big ticket items like that. If the government decides to spend more money on education, that would increase aggregate demand, so there's A. Changes in productivity go to aggregate supply, so this is our 1C here. And number 10, so even if people don't sell their stocks, they'll feel wealthier, and so that will increase aggregate demand. Of course, if they sell, then they'll buy stuff, and that will also increase aggregate demand. So hopefully you did well on those 10. All right. So now we're going to put everything together here. We're going to put together long run and short run so that we have inflationary and recessionary gaps. We'll start here. So at this point, the economy is in full equilibrium, short run equilibrium and long run equilibrium. A short run always happens when you have AD-AS intersect, but this is also a long run stable position because you have LRAS there as well. In terms of numbers, it's important to know this. Your inflation is somewhere around 2% or so. That's the Fed's goal. Your unemployment is about 5% because that's your natural rate of unemployment. That's your full unemployment. So 5% unemployment. And growth rate around 2 to 3% because this is dealing with the United States or other industrialized economy. So we've got stable inflation, stable growth, and we have our stable unemployment rate as well. Then we have an increase in aggregate demand. So the government increases spending from this stable position. So now we're beyond the LRAS. If the LRAS is equivalent to a production possibility frontier, this, on the PPF graph is impossible. But on this graph, it is. So we can be beyond our potential GDP for a brief period of time. And really what we're saying here is that our unemployment rate drops, let's say from 5% to 3.5%. So we have very low unemployment, and that's temporary. Our inflation now is going higher. So we're running at, let's say, 4% inflation. Our growth, let's say, goes from 2% or 3% up to 4.5%. So it's important to understand what the numbers are. These aren't huge changes, but they're significant in terms of percentages. But we have a temporary inflationary gap here. Next, output. You have to remember that's your real GDP. So output is above your potential GDP. So your potential GDP, your LRAS, and that's equivalent to your PPF. So let's flip it around and do it the opposite way. So now we're going to have consumer spending dropping, and so we have lower price level and lower output. So the price level, let's say, is running at around 1%. So we have 1% inflation, we have 1% growth. Things aren't good here in the recessionary gap. We have high unemployment. So unemployment is higher than our natural rate. So unemployment might be at 6.5%. So actual GDP is below potential GDP. On a PPF graph, this would be a dot inside of the curve. Can't really graph the inflationary gap on a PPF, but we can graph the recessionary gap. So now we have a new situation. We have another recessionary situation, in this case, stagflation. So remember, this is the worst situation because prices are higher and unemployment is going up and our growth is also falling. So we have a shift left, oil shock, price of oil dramatically goes up. So now our inflation is high. You see our price level went up. So we're running at about 6.5%, 7%. Unemployment and price level, it might be that high as well. Anywhere above 5% here would work. So price level is high, unemployment high, growth level low. And this is still a recessionary gap. So you're to the left of LRAS. Even though price level is high, this is a special kind of recession. It's a stagnant economy, but you also have inflation. Still a recessionary gap. All right, that was all the short run. Now we're going to bring things to the long run. So we start at a position of full-on equilibrium. Then consumer spending goes up. We have that shift to the right. Now, what are workers going to do? What's the situation here? Inflation is running high. People come up for their contract and they tell their boss, inflation's going up. So in order to fix this in the long run, workers will demand higher wages. This is the key. So we're going to say government's not going to do anything. This is just the market. This is just people. So production costs are increasing because inflation is higher, so inputs are going up. Workers decide that they're going to request higher wages. So AS shifts to the left. And so this is what is now long-run equilibrium again. You go back to your natural rate of growth, natural rate of unemployment. Price level, though, is now higher. So just to that sequence again, you have some reason why aggregate demand increased, consumers spending more. Then when you're in the inflationary gap, workers request higher wages. That's key. Workers are requesting higher wages. So that brings you back to your 5% unemployment at a higher price level. All right. So that was the long-run situation for inflationary gap. Now we're going to do the long-run situation for a recessionary gap. So consumer spending plummets, their expectations fall, AD shifts to the left. So we have lower inflation, lower growth, higher unemployment. How do we fix this? Well, there's no government intervention again. That's key. That's going to be on the FRQ. You're going to get that situation of no government intervention. So what has to happen? Workers have to accept lower wages. And look at where the PL2 intersection is. It's on the AD1 line, not the original line. So you have the new AD1, AS1 intersection at YE. So workers are accepting lower wages and production costs fall. In the real world, usually businesses don't lower wages for everybody. Usually they lay off people. But from the business perspective, their salary costs are lower. So AS shifts to the right. All right, so that's it. You're going to practice this a couple different ways. You've got the handout now to get from the sub, and then you also have the JMs to work on, and that document has been shared with you. So remember, in an inflationary gap, workers will demand higher wages, and in a recessionary gap, workers will accept lower wages. And both of those assume there's no government intervention. We haven't really talked about fiscal or monetary policy yet. And that's it. Thank you.